Hello, I'm Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group. Russia's invasion of Ukraine and talks of sanctions have triggered market fears of a brutal supply crunch of oil and other commodities. Our analysts continue to monitor the impact on Malaysia and ASEAN and highlight where investors can potentially find shelter in sectors like oil and gas, banking, and Singapore REITs or real estate investment trusts. Our regional co-head of macro research, Chua Hak, moderates the conversation for today's Monday briefing.
Hey, hi, good morning. It's 7 March. So the Ukraine-Russia crisis and sanctions are dampening the growth outlook, even as the geopolitical worries have moderated expectation of how much the Fed and other key central banks might tighten monetary policy. I think markets have shifted now to pricing about 5 rate hikes from the Fed. That's down from about 6 to 7 before this Ukraine invasion. The strong US jobs report for February, with the US economy adding 678,000 jobs and the unemployment rate sliding slightly to 3.8%, pretty much confirms that the Fed will proceed with the interest rate hike this month, I think despite the risk of slow growth. It was a risk-off for markets last week, while safe haven assets like the US dollar, gold, and government bonds rose. The MSCI World Index fell 2.8% during the week to the lowest level since April 2021. The Fear Index, VIX, rose 16%. The US 10-year yield fell 23 bips last week to 1.73%. The German 10-year bond yield fell by a larger 30 bips and is now below zero again. The Russian ruble fell by another 20%. The Dow and SP fell by about 1.3%, and the Nasdaq tanked even steeper 3%. European stocks fell to a one-year low. The Pan-Regional Stock 600 Index fell 7%. That's the worst weekly decline since the pandemic fuel sell-off in March 2020. There was zero data on January retail sales as well, and that disappointed. In Asia, MSCI Asia Pacific Index fell 1.6% for the week. The sell-off was largely led by the Hang Seng Index, which plunged by almost 4%. I think not helped by rumors of a possible lockdown in Hong Kong as well. And Singapore also fell by about 2%. Again, ASEAN markets are, I guess, remarkably resilient, with Philippines up 1.8%, Malaysia up 1%, Vietnam 0.5%, Indonesia still in a positive, despite all the volatility. Commodity prices soared to records as the Ukraine crisis threatened key supplies of oil and gas, food crops, and metals that were already tight even before the war. The Bloomberg Commodity Index, which tracks 23 futures contracts, rose 13% last week. Again, Russia is a major supplier of crude oil, natural gas, grains, fertilizers, and metals such as aluminium and palladium. And Europe depends on Russia for about a quarter of its crude oil and a third of its natural gas. Actually, on the news this morning, there's talk that the US may be thinking of suspending Russian oil imports, and that's led to the Brent oil prices spiking up to $130 this morning. So I think US futures are already down by another 300 points. So aluminum and copper as well touched fresh record highs. Nickel reached an 11-year high. Gold prices rose more than 4%. Palladium prices rose 25%. Russia accounts for about 40% of the global production of palladium. Just to highlight one of the data points in ASEAN last week, I think Thailand is starting to see the inflation pressures spiked up in February to 5.3%. That's a 9-year high, and GA has raised the inflation forecast. For this week, markets will be looking out for the ECB monetary policy decision and updated macro growth inflation forecast. That's out on Thursday. I think given the current chaos, the ECB is likely to stand pat. Other notable data releases in Europe include the January industrial production, but also the final 4Q GDP for the whole Eurozone. In the UK, markets will turn their attention on the GDP release, as well as the January industrial production and trade balance. US macro data releases a bit thin this week, but the spotlight will be on the January CPI numbers, inflation on Thursday. And looking at the markets, they're expecting headline inflation to continue rising to 7.9%, which would be the highest reading since January 1982. US core inflation is expected to accelerate as well, 6.4%, possibly that's the highest in 40 years. So the Fed is clearly going to face a real dilemma here, balancing of the rising inflation costs with prospects of slower growth or even recession. In Asia, focus will be on China's National People's Congress, which began on Saturday, continues this week. On Saturday, Premier Li Keqiang warned of a grave and uncertain outlook against the backdrop of the COVID virus, a property slump, and the uncertainty over the impact from the Ukraine war. he announced that China will set a growth target of around 5.5% for 2022. That's the higher end of market expectations, between 5 to 5.5, but this will still be the lowest since 1991. We actually think 5.5% is ambitious, and we think that China's growth will likely come in at about 5% or even slightly lower. China data out this week includes the trade, as well as the February CPI and PPI, and watch out as well for Taiwan February exports and Malaysia January factory output. South Korea will be voting for a new president on Wednesday, and the markets will be closed there. I think we'll be also watching closely on sanctions. So today we have a Suhaimi on Bank Negara's policy decision last week, Winson on the impact of the Ukraine war on MGS and his rate strategy, Anand on the fourth quarter earnings wrap for Malaysian companies and the key highlights and changes in his latest strategy report, Andy on the FX markets, TJ on the Petronas report card and his oil price outlook. I think he's changed his oil price assumption. Su Tye on the Singapore REITs earnings wrap, Gene on the Singapore tech earnings wrap. So let's kick off with Suhaimi. So Suhaimi, I think Bank Negara left the policy rate unchanged as widely expected. Any other key takeaways from the meeting and policy statement?
Hi, morning Abin, and morning everyone. Few things from last week's Bank Negara MPC meeting. I think number one, the decision to keep OPR at record low 1.75% was unanimous. Secondly, Bank Negara maintained its assessment of continued global economic recovery and firmer domestic economic growth this year, mainly because countries transition from the pandemic phase to the endemic stage of COVID. Hence, the outlook of a sustained economic opening compared with the ins and outs of lockdown last 2 years. But Bank Negara acknowledged the risk to economic outlook still tilted to the downside, even more so now as a result of the Ukraine-Russia military conflict. I think the other point or key takeaway from Bank Negara's MPC meeting and monetary policy statement last week is Bank Negara still expect inflation to remain moderate this year, arguing that the base effect from fuel inflation is dissipating. I think this implies Bank Negara's assumption that fuel subsidy will remain in place. Just to highlight, official headline inflation rate forecast for this year is 2.1%, down from 2.5% last year. In January this year, inflation was 2.3%. Our forecast is 2.7%. Bank Negara also sees core inflation rate normalizing rather than going above its long-term average, which we estimated to be 1.4%. In January this year, core inflation was 1.6%. Last year, core inflation was just 0.7%. So the reason for this uptick in core inflation is because of a normalization in economic activity and due to some pass-through of high input cost. But I think generally, Bank Negara argue core inflation would stay modest because of the continued slack in the economy and labor market as per the persistent negative output gap, which signals demand pull inflation is still contained and still elevated unemployment rate, youth unemployment rate and underemployment rate relative to the pre-COVID-19 levels that mitigate the risk of wage-driven inflation.
So Suhaimi, Malaysia is one of the few net energy exporters in the region. It benefits from rising oil prices, but at the same time, there are also potential impact on inflation as well as the big fuel subsidy bill. So how do you think this Ukraine-Russian conflict will affect this trade-off, ultimately on growth inflation? And I think TJ just raised his assumption on oil prices now to $100 from $80 this year on average. What could the impact be?
I think as mentioned, Bank Negara acknowledged the downside risk to current official growth forecast of 5.5% to 6.5% in view of the Ukraine-Russia conflict. And the earlier mentioned central bank's outlook on inflation moderating this year, I think is challenged by the commodity price impact of the conflict as per the surge in prices of crude oil and grains, which also pushed up CPO prices, thus highlighting the upside risk to inflation. So far, policy responses to contain inflation has been that of price stabilization and supply side measures. As mentioned, there is the continuation of fuel price subsidy, and there's also efforts to control price and ensure supply of essentials like cooking oil and chicken. And the government also announced freezing base electricity tariff hikes for all electricity users in Peninsular Malaysia until end of 2024. we are still penciling a single rate hike of 25 bips, fourth quarter of this year. And I think thus far the multi-speed monetary policy normalization is panning out as per our expectation. Bank Negara kept OPR unchanged last week, despite the certain start of US Fed's interest rate hike cycle later this month, beginning with a 25 basis point hike in Fed fund rate. Monetary Authority of Singapore has started policy tightening since October last year, again in January. And then, as we know, Bank Indonesia signaled hikes in bank's reserve requirement this year, 3 to be precise, in March, June, and September, whereas Bank Negara is committed to maintain its zero rise statutory reserve requirement until end of this year. I think as far as the issue of impact of the upward revision in in-house view on the crude oil price to $100 per barrel, I just want to highlight that I think from an oil-related revenue perspective, the government will benefit because every $10 per barrel increase in crude oil price will boost government coffers by 7.5 billion ringgit. So that's about 0.5% of GDP. But we have fuel subsidy, so that will also raise fuel subsidy costs by 6 billion, or about 0.4% of GDP. So the net fiscal effect is actually small at just 0.1 percentage point of GDP. And within the context of budget 2022 by the government assuming average crude oil price of $66 to $67 per barrel against our house view of $100 per barrel average now, I think the total oil-related revenue will be up by 25 billion, or 1.6% of GDP. But fuel subsidy expenditure will also increase by 20 billion, or 1.3% of GDP. So the net effect is a small positive fiscal impact of 4.8 billion ringgit, or 0.3 percentage point.
Okay, thanks, Suhaimi. Winson, on your Malaysian rate strategy, so how is the Ukraine-Russia conflict complicating the growth versus inflation trade-off, and your view on the MGS outlook?
Hi, morning, Abin. I think, for Malaysia MGS, we are actually tactically bullish. I think we can't escape from talking about the US because they already had an inflation issue even before the Ukraine crisis, because monetary policy was too accommodative and it overstayed for too long. I think we all agree that the Fed will have to hike interest rate at one point. The question is, when it comes to the trade-off, to what extent they are willing to hike, how quick, how much, in order to bring the inflation under control. At the same time, it could actually slow the economic growth. And now, I think with the jump in commodity prices, it is making the trade-off a lot more difficult. And that's why we are seeing very volatile the US Treasury market. But I think net high inflation might continue to force the Fed to hike rate, but with a lower terminal rate. So that's why coming to the MGS, there is a lot of uncertainties. I think the narrative can change just overnight. But if you look at the domestic factors, one, the MGS curve, the RRS are well priced for rate hike. 2 this year and another 3 next year. Can BNM deliver in this kind of environment? There's a big question mark there. And second, domestic supply, I think, is actually digestible. It's neutral. And when it comes to the demand profile, I think it's slightly looking a bit positive, judging from the healthy government bond auction demand, strong order book in PDS, primary offerings. And this year, the reinvestment demand from bond maturity is actually higher compared to last year. And I think quite important is when we spoke to local investors like a month ago, a lot of investors are actually positioning quite lightly. They are worried about the yield to increase, to jump. But if this is not happening, I think a lot of this money will actually find its way back into the market. So I think in the near term, if the Ukraine crisis continue, prolong, or even broaden, I think 10-year yield MGS can actually fall by about 10 bips to the 350 to 360 area. We still like durations for the reason we mentioned before. We like to keep duration exposure as a hedge against the risk of a shorter economic cycle.
So Winson, I wanted to ask you about the yield curve, because it looks like the US 2-year and 10-year spread has narrowed. and it's almost down to about 25 bips, not too far away from turning negative. Or said differently, I think the yield curve is very close to inverting. So what's the track record of an inverted yield curve in predicting past recessions?
It has, I would say, quite a good track of record, although I'm not sure whether it is right for me to use the word good. But basically, it has very high accuracy looking back to the history of all the 5 to 6 US recessions since the 1980s. All were preceded by the inversion of the yield curve. So I think many would agree it is probably the best indicator out there we have, although it's not very good in terms of gauging on the timing when, let's say, following the inversion of the curve, when the recession will actually come. So let's say, coming to the question, will the treasury curve invert? I think our view is this is something that we have always had in our mind over the past few months, as in watch out for the risk of late cycle pricing on the shape of the curve, especially from a rates strategy point of view, with or without the Ukraine-Russia crisis. And I think with this crisis, it is simply bringing forward the risk of an inversion of the curve. When exactly the curve will invert, I think it's a bit hard to tell. It's tough. Yes, I think it should happen sometime this year, but the market is so volatile. The overnight move can be 10, 20 bps. So depending on the changing narrative on the Ukraine crisis, if you look at the US volatility for the past 1 to 2 weeks, it has actually exceeded what we saw back during the taper tantrum, and is only lower than during the global financial crisis and the COVID crisis. So I think volatility will stay.
Okay, thanks, Winson. Anand, on your fourth quarter Malaysian earnings roundup, what are the key highlights, and did earnings beat expectations? And which sectors are driving the earnings recovery?
Hey, hi, morning, Hak Bin, and morning, everyone. I think one of the key thematics for ASEAN markets and why they've been quite resilient through this crisis as well has been the reopening thematic and what it has meant for earnings. And this was quite obvious in the 4Q 21 reporting across the region. I mean, Malaysia was the last to report. And even in Malaysia, there were no underperforming sectors. We had 9 sectors which showed both quarter and quarter as well as year-on-year growth. So a very robust performance, coming off lockdowns and coming off all the other mobility restrictions we've been seeing on a year-on-year and quarter-on-quarter basis. And that was pretty much mirrored in other countries like Singapore and Thailand as well. So I think that reopening thematic will continue to be a lift for ASEAN markets. I look at Malaysia, we're talking about reopening our international borders finally. I look at the Philippines, they're reducing their alert levels as well, and mobility there will improve. And Thailand has reopened as well. So that will continue to be a tailwind, I think, for earnings or corporate earnings going forward. The other thing about ASEAN markets, they're proving very resilient. We are seeing some sort of relative outperformance by the Malaysian benchmark as well as the Indonesian benchmark. And really, this is down to the commodities weightings in these two benchmarks. Like for Malaysia, about a quarter of the KLCI is weighted towards commodity stocks like oil and gas, aluminium, CPO. So that's really been a big support. And that's attracting another change we're seeing in ASEAN, which is quite positive. After years of net outflows by foreigners have been net buyers year to date in quite sizable quantities. So that's another reason why we are seeing this big relative outperformance by ASEAN versus the rest of the world.
So, and then for this ASEAN strategy report, any new stock changes to your top buy or sell recommendations?
Yeah, sure. We continue to have a relatively positive bias in terms of our rating changes. Not many downgrades. We know OCBC in Singapore is one sort of notable given its market cap, but we still like DBS and UOB. Those are among our top picks in Singapore. So it's very OCBC centric. On the other side of the spectrum, we do have a few sizable upgrades. So MHB in Malaysia, with border reopening coming, this airport operator looks like it's about to perform. Also tech in Singapore in terms of venture, which upgraded to a buy as well, looking incredibly cheap. And I think that's a theme among a lot of tech stocks in Singapore and Malaysia. They have been sold down very aggressively. And it may be time to start bottom fishing, for some of them of better quality. And also consumption plays, classic reopening play. So SMPM in the Philippines has been upgraded to buy as well. And finally, before I go, India has initiated on the second largest waste handling company in the country, Antony Waste. This is really part of our ESG portfolio, which we're developing for the region, and a great example of a circular economy stock.
Thanks, Anand. Let's bring in Andy. So Andy, on your latest FX monthly, what are the key themes that will dominate FX movements? And how would you recommend investors position themselves in view of the war and the upcoming Fed meeting?
Hi, morning, Habin. Yeah, in our latest monthly, looking at the 20 or so currency profiles that we covered, I think the main theme would be, of course, Ukraine and the Russia situation. It remains to be dynamic, two-way. So volatility in the emerging market space and how we will cascade into emerging market Asia would be one thing. But surprisingly, CNY is resilient, so it's providing a bit of an anchor for some of the emerging market Asian currencies, including the oil support. And then we will continue to look out for Euro, Swiss franc, which broke parity overnight since 2015. So something that shows that volatility is going to be key. Second is in terms of course, the commodity price and price shocks. And you mentioned, Habin, about the import on Russian oil, whether that will push it up further. Third theme will be on growth fears. Generally, if we see growth fears, we would be trying to factor into the FX markets, but at the moment, not so evident as yet. And then, of course, the Fed theme will be the main one into March, as well as ECB on the 10th of March as well. These are central bank developments that might factor into currencies as well, Habin.
So, Andy, can you just remind us on your Euro forecast? Because, obviously the ruble has collapsed probably about 50% now from its from where it was.
Yeah,
20% last week, and well, to me, it looks like Europe is going to go into a recession. What's your thinking on the euro?
So euro is currently our forecast. We're calling for first quarter about 110, 112. Currently, it's gone below 109. We are on the baseline view for now. A baseline view that this Russian-Ukraine situation baseline scenario would be short term for now. But if it escalates even further, definitely the Euro Swiss franc going below parity for the first time in 2015, it shows evidently some concerns there. We may be some revisions there, but as of now, our forecast for Euro first quarter, end of this March by 110, 112, we're still seeing a recovery of the Euro by towards 115 to 118 by end of this year. But yes, growth fears, like I mentioned, is not fully priced into markets as of now across the board. So if that sort of materializes, I would say Euro could be on a downward trend towards the 105, 1 even in the medium term.
Okay, thanks, Andy. TJ, I guess all the spotlight is on oil, but let's kick off first with the Petronas earnings report card. How is Petronas doing? Is this going to be the savior again for Malaysia this year? And are you expecting a much higher special dividend given where energy prices are trading?
Yeah, hi, Hagbin. Morning, everybody. I think Petronas as a whole is doing well, doing very well. I think they have basically been generating profits at this price last year. They are generating cash. It will be much better this year. Their break-even P&L on a P&L basis is basically below $30 per barrel. And at $100 per barrel, I think they're going to do very, very well. I think in terms of CapEx, they'll be spending more this year. I think they have raised their CapEx growth expectations to 50 billion ringgit for this year versus 30 billion a year ago. For their energy transitions, their 5 years plans, they're going to spend 20% of their CapEx for new energy resources, i.e. renewables, green mobility, and hydrogen. And looking at the way oil price is trending now, we see that there's a very strong likelihood that Petronas will have to pay more in terms of dividends, although they have committed 25 billion ringgit for this year. I think there is upside to it. We understand that the 25 billion ringgit dividend is basically based on oil price assumptions of less than $17 per barrel.
So TJ, you've changed your oil price assumption. You raised it to $100 average from $80 up to 8%, more than 20%. Again, overnight, there's news that the US and Europe might, ban the imports of, oil from Russia. Just looking at some data, and about 8% of imports of crude oil and refined products to the US come from Russia. That's pretty large. So can you share views on your recent oil price hike and what's driving this increase?
Yeah, I think in this new super cycle, as we call it, I think the oil market is facing an energy trilemma. Firstly, demand is picking up strongly, and it's going to surpass 2019's consumption of more than 100 million barrels per day. Secondly, on the supply side, I think supply can't catch up with the demand expectations. I think the energy market has been severely underinvested since 2014. Basically whatever capex that we are putting in this year will not be realized immediately. It will take at least 2 to 3 years to basically see a resumption in supply growth. That's the second thing. Spare capacity overall is falling. Inventories are falling as well. And if you were to look at OPEC Plus, they are happy with this higher oil price. And in the fact that because of this underinvestment in the past, they have not been able to basically match their quota outputs, which has been falling since second half of last year itself. So these are basically telltale signs that the market is very, very tight in terms of demand and supply dynamics. And I think rising geopolitical risks is one of the wild cards that has basically seen oil price moving beyond $100 per barrel now. So looking at where things goes, this energy trilemma is going to stay for the next 2 to 3 years.
Quickly, TJ, what's your top pick now in the oil and gas sector in Malaysia?
Okay, for the Malaysian oil and gas plays, I think the top pick will be Hibiscus. We've basically raised our target price to 190 today. We have raised our oil price assumptions from $80 to $100 now. They are the independent upstream oil and gas player. I think they are very sensitive towards oil price movements. Every $10 move in oil price will basically see their earnings go up by 30%.
Okay, thanks, TJ. Yeah, so on the Singapore REITs, I think in the front page of the Business Times today, it's reported that 1/3 of the 44 Singapore REITs are trading within 5% of their 52-week lows. So can you share what the key highlights are and takeaways are from the recent earnings report for quarter, and should investors be worried about the rising interest rates and the geopolitics?
Good morning, Hak Bin. Morning, everyone. So I think in summary, we saw evidence of broad-based DPU recovery across the subsectors on the back of resilient occupancies, importantly, improving leasing sentiment and momentum going into the rest of the year. We expect a stronger earnings outlook against the positive macro overlay and further reopening efforts here. DPUs grew about 10% last year. We expect this to accelerate to about 12% for this year. This will be due to the absence of rental waivers, due to rising rents as business activities normalize, and also contributions from acquisitions. Interest rates expectations are a key risk for the sector. Our fixed income team sees the 10-year bond yields reaching 1.9% by the end of this year, then peaking at around 2.25% in this cycle. Whether the Fed hikes rates at a measured or faster pace in the next 12 to 18 months. I think the US yield curve had steepened last year, but with the 2-year bond yields now at 1.53%, it's close to our year-end target. I think further steepening of the yield curve unlikely for now. So the REITs are 7% off the recent peaks. The sector yield spread is 3.7%, one standard deviation above the 5-year historical average. And I think higher rates largely priced in. DPUs are cushioned by strong balance sheets, high fixed borrowings, and when we run sensitivities, 50 basis point increase to our assumptions will mean a very low 1 to 4% in terms of DPU impact. 50 basis points increase in our DDM discount rates will lower target prices by an average about 9%.
So Su Tye, can you remind us which sectors are you most positive and your top picks in Singapore amongst the REITs post the results?
So we are most positive on office, then industrial, ahead of retail and then hospitality. The office sector's down cycle was short-lived, with Grade A office rents climbing close to 4% last year after falling 10% in 2020. That is less than the 15% fall between 2011 to 13. And also that's less than the 21% decline between 2015 to 2017. The sector is recovering on stronger than expected demand, driven by tech occupier and expansion, driven by firms taking flight to quality, and also an easing of work from home protocols. At the same time, new supply is limited. It's being pushed out to after 2024. That's allowing the office landlords to gain pricing power in this upcycle. We think rents will rise 7% this year and 5% or higher next year. The physical market is active. It will increase acquisition opportunities for the REITs, especially if their cost of capital improves. We continue to like the industrial REITs for their structural growth drivers and increasing new economy asset concentration. They were at the other end of the rotation trade, and the large cap names are now yielding 5 to 6%. We think valuations are undemanding, especially given the stronger AUM profiles that should position them well to take advantage of compressing cap rates and rising asset values as they push ahead on plans to recycle capital to fund further acquisition growth. Acquisitions will be the key theme for this year, and also catalysts together with the bottoming out of rents and growth will be led by logistics and then business park space. I think the sector is under-owned. We like office REITs and the large cap industrial names with new economy exposure. Our top picks will be Ascendas REIT, the CapitaLand Integrated Commercial Trust, Maple Tree Industrial Trust, and Suntec REIT. They are expected to deliver higher total return potential with 5.5 to 6% dividend yield, and then 4.5 to 5% DPU growth. Thanks.
Thanks, Su Tye. Let's bring in Jean. So Jean, I think tech stocks have fallen pretty sharply over the past few months. Singapore tech names are not spared. What are the key highlights and takeaways from the Singapore tech earnings results? Any big positive surprises or misses?
Hi, morning, Hak Bin. So I just want to highlight maybe two or three key trends or takeaways. First of all, companies with good exposure to semi-equipment continue to do very well. For instance, AEM's full year results was a strong beat on both our and consensus estimates. And this is on the back of the current ramp of new generation test handlers for Intel. So that's one. UMS's revenue in the fourth quarter nearly doubled year on year on strong momentum from its key customer Applied Materials and also from the consolidation of JP to become a subsidiary. And this consolidation allowed them, or rather allowed UMS more capacity to handle the orders from Applied Materials. Now, the next thing is that the worst of chip shortages appear to be over and things seem to be slightly easing. So when we talk to some companies, some of them expect chip shortages to last for longer, i.e. lasting to 2023. But for some companies, for instance, like Aztec, Venture, and Franken, they are seeing sequential improvements in their supply chains. So it seems like barring further negative surprises, it seems like supply side problems are easing. And lastly, overall, the demand outlook seems fairly robust across both upstream, being the semiconductor related markets, as well as downstream, being the rest of the end markets. Of course, the key risks to consider here would be inflation, as well as some as well the supply chain vulnerabilities from long-term Russia-Ukraine conflict.
So I just want to throw in this question here because I read news reports that Russia accounts for 20% of the palladium exports, which is a component used in chips. And then Ukraine also accounts for I think 70% of neon gas, which is apparently used in semiconductors production as well. So have you heard any noises that this this could lead to, again, supply chain disruptions? And after that, can you just also highlight which Singapore tech names are you recommending post the results?
palladium side of things, we haven't heard too much. But on the neon side, so far, some of the large chip makers have said that they have diversified their neon sourcing following the 2014 episode, the conflict having to do with Crimea. So far, they are not expecting much yet. I think one of the key areas to also watch out for would be aluminium, because aluminium is a key raw material in a lot of the semicon equipment. So we are still watching out on this space. Now, on the Hak Bin, I believe your question then is on which Singapore names we like post results. Our topic is still AEM. We think that AEM is still early in their current earnings cycle and is a beneficiary of increased test requirements from Intel as Intel embarks on their roadmap. And we also like Venture and Franken for their diversity and on the back of still robust demand backdrop across various end markets. We like UMS still, but our conviction is temporarily reduced until it resolves certain tax issues.
Yeah, great. Thanks, Jane.
Thank you.
That's all we have today. Have a good week.
Talk to your trading rep and download the reports at the Maybank Trade app and follow us on Spotify and Apple Podcasts for updates. Have a good week ahead. I'm Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group.